So what do I mean by buy versus build? Essentially, what I mean is, should a company look to acquire a firm in an industry that it wants to enter or diversify into, or should it look to build it internally? So, this prompt is mainly for bigger businesses or conglomerates, in many cases, ones that are publicly traded, because they're big enough to make these acquisitions or to kind of enter a new industry by building inwards. And so I'm not sharing yet. I'll be sharing right after I finish this kind of explanation. So that's essentially what buy versus build is. And what this prompt that we're going to take a look at today is essentially going to be the same type of problem. So I didn't put any company names or anything like that, but essentially, is the company going to look to buy or build the product that, or the industry that it's entering into? So I'm going to share my screen. So right now, can you guys see my Excel sheet?
Oh yeah, we can see it.
Okay, cool. Sometimes I don't know which, because I have a monitor, sometimes I don't know which one's sharing. But so you should be seeing my assumptions sheet as it kind of shows in the tab down there. So these are the assumptions, and I'll go over them one by one before, later on. But I want to show you, so this is the assumptions sheet. This is the free cash flow sheet. So I'm going to get rid of self-help, that's from before. But essentially, we are going to build a cash flow statement to kind of measure these four values: IRR, NPV, profitability index. That's what PI is. That's how profitable the cash inflows of a company is given its initial investment, as well as the payback period. How long does it take for a company to get paid back? I'm going to get rid of those. Basically, all the yellow cells are what we're going to want to fill in. And all the white cells are either pre-filled or they are empty, like net proceeds, opportunity cost, side effects. Those might be there for other company cash flows, but we're not going to be too concerned with those. And some of them are automatically calculated or linked, like the net incomes are linked with the net incomes down here. The CAGRs, they're essentially linked as well. CAGR meaning compounded annual growth rate, which is the multi-year growth rate of any line item in an income statement. So this would be the CAGR of revenue. This isn't as important, but it is interesting to see. Operating costs, obviously, they're not finalized because this is just what's been hard coded in. We will code everything in afterwards. So the first thing I want to look at, obviously, this is all income statement related. So the buying company, it will cost $1.45 million to buy and begin selling immediately. So this is if you acquire another firm, but building it from scratch will cost $800,000 in year one. So it costs less, but you can't sell straight away in year one because it takes around a year to build the infrastructure in order to start selling in year two or the following year. And the next one is revenues. We'll go over that later. Sorry, not revenues, working capital, which is also important in calculating the cash flow. And then there's units and all that other stuff. So annual unit price, units, and fixed depreciation, which is how much your assets lose value by every year. They're already given. We don't have to worry about that. They're on the other sheet. Marketing, shipping, general administrative, those are all we have to calculate. But before I even get to the free cash flow sheet, we need to calculate the cost of capital. So this, you might know this as the discount rate. This is how much the cash flows in the future have to be discounted, or by what percent, in order to get their present value today. So what are future cash flows worth today based on the time value of money and the cost of debt and equity? Cost of capital basically means the cost to the business of having debt and equity financing from external investors. So we need to calculate that first. As a result, we have to go to the WACC tab. Now, in order to find the WACC, we have to find a couple of different things. So over here, I listed CAPM and WACC. WACC is obviously the final thing that we need to find, but CAPM is what we need to find for the cost of equity. So actually, I'm going to write out the WACC equation first. I feel like that'll be intuitive. So the weighted average cost of capital I thought it was small, but I think we're good. Weighted average cost of capital equals the cost of debt times percent of debt times 1 minus the tax rate plus cost of equity times percent of equity. So that is your weighted average cost of capital formula. This is what we're going to need in order to find WACC. So we need a couple different things. We need cost of debt, we need percent debt, cost of equity, percent of equity, and then the tax rate that's already given, but we can write that down again. All right. So for cost of debt, what we can do in order to find it, there are a couple different ways. You can find the yield to maturity of a 10-year bond, or not a treasury, but a 10-year bond that is closely related to the maturity of your assets. But what we're going to do is much simpler. Essentially, cost of debt equals interest expense divided by debt. So we have a couple values already given, which is good for us. We could just use those. So for cost of debt, all we need to do is do the interest expense divided by the total debt obligations, and you get that. Don't autofill the other stuff. Yeah, so I'll try to zoom in. I know it's kind of small. Okay, that should be good. Sometimes I might need to zoom out just to, when I go back to the free cash flow sheet, just because there's so much going on that I want to get like a bird's eye view of everything, but I'll zoom in for this one. Let me know if this is still pretty zoomed out. This is I think at 100%. Okay, so this is how we find cost of debt. Let's bring it back to percentage. Okay. Now for percent debt, this is just easy. Percent debt is just debt over debt plus equity. And similarly, percent equity is just equity over debt plus equity. Basically, what percent of your total capital structure, or your debt and equity combined, is debt or is equity? So for this, actually an easier way to do it would just be cap structure. Cap structure, what we're going to do is just do shareholders' equity plus debt. This is your total amount of capital, $490,000. This is your capital structure. Now our job's a lot easier. All we have to do for percent debt is just do debt obligations divided by capital structure. We get about 0.5353%. For percent equity, we do the same thing, but this time with shareholders' equity over the total capital structure. I'm going to convert those to percentages again just to make it more readable. And yeah, that's about what it is, 53% and 46%. Notice how they both add up to 100 because both of them combined is the total capital structure of the firm. Now for cost of equity, this is what we need CAPM for. So CAPM is the cost of equity. So what's the CAPM equation? CAPM equation is the risk-free rate plus your beta times your market return. That's how much you expect to get in the market, minus your risk-free rate. And that last part is in parentheses. So that thing in the parentheses, market return minus risk-free, that's called the market risk premium. That is how, that is basically the opportunity cost of an investor's risk aversion. So how much is the investor willing to accept, or how much are they going to accept in order to take on more risk in the market? That's what market return minus risk-free is. It's called the market risk premium. We went over that before as well. So we have the equation down here. We know CAPM is cost of equity. I'm actually going to make this right indented so it's easier to see. We're just basically going to plug and chug here because we already have all of the things that we need here. Cost of equity, CAPM formula. Where's the risk-free rate? It's up there. Plus your market beta, 0.6. That means for every 1% that the S&P 500, for example, moves, your stock, or if this company was publicly traded, this company will move about 0.6%. Or for every 10% the market moves, this stock or this company will move 6% in a positive direction, in the same direction as the market, actually. Okay, so we have risk-free rate plus beta times, got to put the parentheses, market rate, 11%, minus risk-free rate. So the cost of equity is 8.2%. All right. So we have that now. Oh, and one last thing is just tax rate that we already have. For CAPM, I can put cost of equity there. And now for WACC, I have all the necessary components in order to calculate WACC. So let's do it. So first we need cost of debt. Actually, we don't need the parentheses there. So cost of debt multiplied by percent debt, multiplied by 1 minus the tax rate, not just the tax rate, because this will act as the tax shield. Whatever's left over is what the investors are going to expect. Obviously, they're not going to expect a return that's taxed because that would have been taxed anyway. That's not the firm's fault. That's the government taking money away from the company. So you have to take that out of WACC considerations. So we're not going to count that. We're only going to count what's left over, which is 1 minus 35%, which is 65%. Plus, now we have the equity part. Now this is cost of equity times percent equity. So all in all, our WACC, this number right over here, this very important number that we're going to need later on, is 9.5%. This means that your investors are expecting a 9.5% return from this project or from this company, or really from this buy versus build scenario. So we have the WACC. Now the good thing is I already linked the WACC to cost of capital over here. It's in the other sheet. So we have this at our disposal. I'm going to zoom out just a little bit. I think that should be good. Okay, once again, if you can't see, just let me know. I can zoom back in. This is just easier for me to kind of work things out. Now, we can do a couple easy calculations here without even looking at the assumptions. Revenue, easy. Right, that's just unit times price per unit. We can drag that across. All right. Now the CAGR, notice, it means that on average, the yearly growth rate for revenue between 2019 and 2024 was 8.13%. So that's all the CAGRs. COGS, same thing, except instead of price per unit, you're doing cost per unit times units sold. Drag that across as well. Okay, the balance sheet, sorry, the income statement is coming together. Let's do the same thing down here. Now, notice in 2019, we don't have any statements. We don't have any numbers because we're still building it. This is the build scenario. So we still need to build the infrastructure needed to sell this product. And that's why in 2020 is when we start, developing sales. Same thing. Drag that across, price times units, COGS. That's the same thing. It's just cost per unit times total units. All right, so we got the easy part done. Now we have to do the SG&A, or the operating costs. And these are in the assumptions. Buying company 1.45, build 800K, we already know that. 20% of revenues is total working capital. We're honestly going to worry about that later. Marketing increases 5% per year in buy, decreases 30% each year in build. So this, in the build scenario, the company is going to be very marketing heavy initially, and then it's going to slowly, well, not slowly, actually pretty rapidly drop off its marketing expenses and reinvest probably back into the company for R&D, cut its operating costs a little bit. So let's go to buy. It increases 5% per year in buy, right? So this is the buy. All we have to do is reference the last cell times 1.05. And we could just drag that across and it's going to increase by 1.05. If we do the CAGR, I'm not going to do it now, but if you did it, then it would just be 5% because it's growing consistently throughout the 5 years. For distribution, actually, no. Let's do marketing first for build. The decreases by 30%. So we're referencing the last cell. If it decreases by 30%, all you have to do is multiply by 0.7 because only 0.7 of the previous year's marketing expenses remain. So you just drag that across. All right, we're done with marketing. Now let's go to the other ones. shipping costs are, so shipping costs are $5 for 75% of the units, or three quarters of the units, and $3 for the remaining quarter of units sold. So the distribution costs basically are the shipping costs. So remember what it said. For 75% of all the units, it's $5 for shipping, and for the other quarter of the total units, it's $3. And so what we're going to do is total units times 0.75, that's 75% of the total units, is going to be $5. Then we're going to do plus total units again, this time just times 0.25%, sorry, times 0.25 or 25%, times $3. So the remaining 25% of total units are $3. And that's what you should get. Let me see if I did that right. Yeah, 5 for 75%. Cool. All we got to do is just drag this across. Okay, same thing here. Total units times 0.75 times 5 plus total units times 0.25 times 3. Okay, drag it across. We're done with distribution. We have one thing left on the income statement, and we don't have to do anything else. I pretty much spared all of you guys from having to see me do operating costs. You know, that's just that's an easy sum of all of these numbers. Income before tax, you know, that's just gross profit minus minus operating costs. I didn't take into account interest here just for the sake of ease, even though interest would probably be here. And this company does have interest expense because, as we saw in the WACC, you know, this company has significant interest expense. But we're not going to count that just for the sake of ease. So if you do gross profit minus operating costs, that's EBT. EBT minus taxes, tax rate is 35%. I think that's another assumption that we found out in the WACC sheet. That is already given here. EBT minus taxes is your earnings or your net income. So we don't need to calculate any of that. But let's finish off with general administrative costs. So general admin grows by 1% in year 1 and 2% each following. Okay, so in the buy scenario, year 1 is 2020. So we just have to grow this by 1%. Then we grow the 2020 general admin cost by 2% or 1.02. And then all we have to do is just drag it across from 2022 to 2024. And we do the same thing here. In this case, year 1 is 2021. We grow it by 1%. Then we grow the 2021 costs by 2%. And all we have to do is just drag it across to 2023 and 2024, and our income statement is complete. All right, that's part 1 done. Now comes the actual analysis part. So if you look up here, the net income has already been auto-populated, so that's good. We don't have to worry about any of that for both cases, you know. And also, just one more thing, I don't think I mentioned, this analysis is very helpful for you know, tracking projects that have different lengths. You know, this one is from 2019 to 2024. The build scenario is 2020 really to 2024. It's very different in terms of its cash flow. So if you standardize, you know, the numbers through which you're doing the analysis by, it's a lot easier for you to get better numbers and more accurate numbers. But you'll pretty much see that as we go through this model even further. So working capital, this is the last assumption that we pretty much have to take into account. After that, everything should be auto-calculated. So 20% of revenues is total working capital, and 2019 working capital is 10% of revenues. Now remember, working capital is current assets minus current liabilities. I didn't make a balance sheet just, you know, to make things a little bit easier. So I just said that as a percent of sales, you can assume working capital is about 20%, except for 2019 where it's 10%. Okay, so in 2019, we're going to do 10% or 0.1 times the 2019 revenues. So that's what we get. That's the working capital for 2019. And every year after that, it's 20%. So equals 0.2 times that year's revenues. Or we can just drag that across. Now, why this is so important is the changes in working capital. So when you're doing change in working capital, you're doing the current year minus the previous year. And in terms of cash flow, when you're increasing your amount of working capital, you're spending money, right? Your working capital is your inventory and your assets. When that number increases, you are spending money, or you're taking out debt, or you're taking out equity in order to buy those assets and inventory. Now that is bad for cash flow because you're using cash. That's cash leaving the firm. That's cash leaving your firm's coffers. As a result, when this changes in working capital is positive, that means your cash flow is decreasing, which we'll kind of see in the FCF calculation. We're going to take this out. All right, same thing here. 2019, obviously there's no working capital there because we're not spending any for this project. We're still building. So we don't have to care about the 10% thing in 2019. All we have to do is 20% of revenues from 2020 to 2024 for the build scenario. We have that. If I drag this across, it should work. I believe that's the correct number. 1552. Yes, 2021. Okay. So we have changes in working capital. Now we can calculate our cash flows. So this is our the future value of our free cash flows. It's not just FCF because we haven't present valued it. This is what it would be without the discount rate. What do we do? In order to calculate free cash flows, you take the net income, you add back depreciation. You'd also add back amortization, but we don't have any here. So it'd just be EBIT plus D. Sorry, not EBIT, net income plus D. Then you would subtract capital expenditures, or in this case, just add back because it's already a negative number. Because, if capital, the more you spend on capital expenditures, the more money is leaving your firm because you're spending it on something to, improve the sales of your company in the future or get at a competitive advantage. So in this case, I'm going to add it because it's already a negative number. But if this was a positive number, you'd subtract it. And finally, we are going to subtract the changes in working capital. There's no change in working capital in year one because there's no previous year in terms of this project. So for that, it would just be 0. But if we drag this across, these are the numbers that we get. Let's just make sure they check out. So C3 plus C4. C5, there's not going to be anything because there's no CapEx here, which makes sense. We only care about the changes. We don't care about the total working capital, and that's pretty much it. And it checks out here as well for all the other cells. Now let's do the same thing here. For 2019, I'm just going to make it equal to CapEx because, that's the only thing there. 2020 onwards, we're going to have to use the full formula. So equals net income plus depreciation minus your changes in working capital. All right, so you just drag that across. Okay. Well, wait, is this? Okay, there we go. Yeah. So now the final step is to present value all of these future valued cash flows. So here's what I'm going to do. Assume that the current year is 2019. I'm going to make this note. Assume the current year is 2019. Now, based off of that, 2019 is going to be year 0 for both years. All right. So we're going to need that for PV. All we do is take the future cash flow, divide it by 1 plus your cost of capital. We're going to anchor this so that we can drag it across. So we're going to put the $sign so that even when we drag it across, that that cell B15 is still, held constant to the power of T. Now, what's T going to be? T is just going to be the year. So the current year is year 0, but I don't want to hard code it. What I'm going to do instead is I'm going to do what's up top minus 2019. That way, when I do, shift the formula over and like put that formula in its adjacent cells, it's going to take 2020, 2021, 2022, etc. And it's going to do the math for me. So B1 for the next cell changes to 2020. 2020 minus 2019 is 1, which makes sense because 2020 is year 1. 2021 minus 2019 is 2. It's year 2, makes sense. So that's why I'm going to write the formula like this. I hard-coded the 2019 just because the current year is 2019, so it's just easier. Let's drag it across, and that's about the number we should be expecting, or those are the numbers. Now let's do the same exact thing. Okay, future value divided by 1 plus your cost of capital to the power of what's up top minus 2019. And drag it across. Okay, we're getting some numbers now. So this should be pretty exciting. Awesome. So what do we have so far? Basically, what I'm going to do is the better numbers that we have so far. Obviously, there's one we don't have yet, but from what we have so far, I'm just going to put in green the project that is, or the option that is better based on these numbers. All right. So let's compare IRR. Internal rate of return, that's how much the company's operations are generating internally, without any external financing, anything like that. Just in terms of its cash flows, what is the return that the company is giving its shareholders? So this is 53%. That's way higher than the cost of capital. That's very good. 47% is also way higher than the cost of capital, 9.5%. So no matter what the company does, it's making the shareholders a lot more money than they anticipated, than they expected, really. You're making them almost like 5 times the money. But the build scenario narrowly wins out here because your IRR is just a little bit higher and it gives the shareholders just a little bit better of an expected return, 6% better actually. So we're going to stick with that. NPV, this is your net present value. This is the present value of all of your future cash flows. So all I did was I NPV'd. Actually, this equation is wrong. What I should do is just take the sum. Because we've already PV'd the stuff at the bottom here. All we have to do is just take the sum of them. You would use the NPV formula if you didn't, find the present values already. And then you just take the cost of capital and do the future values. But since we already PV'd, all we'd have to do is take the sum. Okay, so these are the actual net present values. So disregard the previous numbers. Over here, the build scenario also wins out. So the net present value of its future cash flows from 2019 to 2024 is about 3.2 million compared to the 2.9 million from the buy scenario. So we're going to put this one in green too. Profitability index. Let's look at the equation here. This is the sum of all the future cash flows divided by negative initial investment. This is based on your initial investment. How many times are you going to return that money to your shareholders over here, right? So over here, based on the initial investment of 1.45 million, the profitability index is actually pretty good. It's close to 3, which means the buy scenario returns the capital back to the shareholders around 3 times over, but it's around pretty much 5 times over for all intents and purposes in the build scenario. That's really, really good. That's pretty much making what you spent in CapEx every year in profit because it's 5 years, right? So that's really, really good. And so clearly the build scenario is better here. Now already the build scenario is pretty much won. If we're only looking at these 4 categories, the build scenario is already better because it takes the cake for 3. But, just to illustrate some concepts, let's also see payback period. The payback period is how long it'll take for the investors to get their returns back. In this case, their funding back. In this case, the funding is all tied up in CapEx. So we know that the CapEx for the buy scenario is 1.45 million. This is not like one equation. You're kind of going to have to do this intuitively. So let's see how long it takes. So the first year, you're still down 1.12 million. Obviously, you're not going to pay it back. You're actually in the red. I'm going to add back this. I'm going to add back 765. Now look here. This number that I got after 2021 is negative 253K. We're obviously going to pay it back by 2022 because our PV of the 2022 cash flow is higher than what we still need to pay back. Now, what we can do here is take the negative of what we need to pay back left to the total income we're going to get in 2022 as a present value. Now, why we do this is we're assuming we're making income steadily. So we're making an equal amount of income every month. We're not making more at the end of the month than we are at the end of the year than we are at the beginning of the year. We're making an equal amount. It's like straight line. So this number over here, what we mean is that 25% of the way through 2022, or a quarter of the way through 2022, we're essentially going to pay off our investors. So that's what this means. Whatever is left divided by the total income we're going to get in 2022. Sorry, the total cash flows we're going to get in 2022 was 0.25. Now for payback period, so I know that by 2021, we still need to pay some back. So that's 2 full years, 2020 and 2021. So 2 plus whatever's left in 2022, which is this number. And that's just 2.25, which means it takes about 2.25 years for investors to get their money back. Now let's do the same exact thing for build. And we know build is better than buy already, but let's just do it because why not, right? Do the same thing. Your CapEx is 800K, so that's negative. Add back the first year, we're even more in the negative, so you keep adding back, still in the negative. And here's what happens. We actually end up in the positive when we go to 2022. So I'm not going to add back the 2022 cash flow. I'm going to keep it at that. We're going to do the exact same thing, negative of whatever we have left to pay back, divided by the 2022 income. Okay, so about 92% through 2022, which is pretty much most of the year, we will have paid back our investors. So 2020 and 2021, those are 2 full years. So 2 plus whatever is left in 2022 that we have to pay back. So that's just 0.92. And we get the payback period of 2.92. All right, so that did take a bit of work, but we did finally find the payback period. There's no easy formula to this, not that I know of. There probably is an optimized way to do this. I think I did it the long way, but it didn't take that long. I was explaining, so it took a little longer than it really should. So essentially, what do these two numbers mean? So the 2.25 is actually better because it means that the investors are getting their money back quicker than in the buy scenario than if they invested in the build scenario. In the build scenario, you're getting your money back 2.92 years after investing. Whereas in the buy scenario, you're getting it back in 2.25 years. So it's not much, but it's a little bit of a win for the buy scenario. So let's do a final score. Let's do a final score. Buy, build. Okay. So how many does buy have? They have 1 win. And how many does build have? Build has 3 wins. Right. So what's the final recommendation here? I'm going to make this as big as I possibly can because it's super important. Okay. We build internally. Make this a little bigger. All right, look at that. So that's what we do, everyone, right? We build internally. We found the cost of capital. We used our assumptions to finish the income statements for both the buy and the build scenarios. We used our income statement to calculate net income for our free cash flow statement. We used our working capital assumptions in order to calculate change in working capital year over year for both buy and build. For free cash flow, all we did was just add net income and depreciation. We subtract out CapEx and we subtract out changes in working capital. Remember, not just working capital, it's changes. It's how much extra we are paying for more working capital from one year to another. And we get the future value of the free cash flow. Then we just PV it back using the cost of capital and the time. And for time, we did whatever's in the column header minus 2019, given that the current year is 2019. So we did that for both buy and build. We found the IRR. Once again, don't calculate IRR manually. It's near impossible. So use the IRR function in Excel. It'll give you the number very, very quickly. Okay, yeah, IRR. And then NPV, I initially used the NPV formula, but since we already have the PVs, we don't need to NPV again. You know, we've already done the PV part. All we need to do is just sum the PVs up, and that's your NPV. 2.9 versus 3.2 almost, clear winner. Profitability index, much higher with the build scenario, and payback period is a little bit better in the buy scenario than the build scenario. But at the end of the day, it's not better enough to convince the company to buy versus build. So we will choose to build. Once again, this is the WACC calculation linked here, and we are done with the Excel demo. All right, so I am going to stop recording now. And